This is where the Paytm problem started. On November 18, 2021, Paytm listed on the Bombay Stock Exchange at about 1950 rupees.
Are you judging people who invested in us as dumb?
By noon, it was trading at 1800.
It's not a straightforward business model.
And by the closing bell, it stopped at about 1564 per share. But it didn't stop there. Paytm's valuation has fallen by 60+% from that IPO day. It became the world's biggest IPO failure and eroded billions from its market share. But the grim news was until recently, when Paytm in its Q3 FY23 results announced some interesting news. It declared operational revenue of about 2000 crores and profitability of 31 crores. This might not sound big, but trust me, it's pretty big news for Indian startups. But why? Why is a payments company turning profitable such big news? And why should you care? Well, as possible shareholders of Paytm and many future Indian startups, I'm going to help you understand what has been happening here. Let's dig in. To understand the hype around Paytm's operational profitability, we need some context. See, 2022 was a disaster for new age Indian startups in the stock market.
The companies simply seems to have not looked at where the market is and just gone ahead and priced itself where it wanted to. So it's a cumulative failure.
They were crowd favorites and were oversubscribed during the listing, but performed terribly in months after the listing. Why? Because all of them were practically making huge losses. See, fall in stock prices is just a result, but they were the outcomes of years of unsustainable growth. So we need to understand two core reasons why Indian startups made losses in the first place. First, startup valuations were not dependent on the company's profit or loss, but on future growth prospects. You see, startups with massive objectives build their businesses with the use of venture capital or private market funding.
Raised $150 million, $130 million, $250 million, $75 million, $215 million.
During 2010s and early 2020s, investors funded startups based on growth and not profitability. And they focused on three things: the company's market share, their revenue growth, or the number of users on their product, which by default did not really encourage disciplined spending by startups. The overall belief became that going for profitability too early would mean limiting growth. So choosing not to be profitable in favor of growth became a sound strategy, but only if there was a path to profits in the future. And this is very important: a path to profit, not profit presently. And second, startups burned before they earned. Basically, they chased growth at all costs. See, new age businesses had a different way of running themselves from the traditional ones. They didn't want to grow slowly and sustainably. They wanted to grab the biggest mindshare in the quickest way possible. For example, look at this chart of how long it took for traditional brands to reach 100 crores in valuation compared to the VC-backed ones. Look here, it took Revlon Cosmetics 20 plus years to be valued at 100 crores. Whereas Sugar reached there in only 4 years. Now it's a different thing if we talk about profits and revenues of the company, but valuation became the name of the game. The idea was simple: grow first, build loyal users, and make profits off of them later. And this set the precedent for how startups grew all over the world. And Indians had American counterparts to look at, right? For example, Facebook and Amazon lost tons of money in their growth years before they turned massively profitable. So it made sense to them. But all of this changed in 2022.
Layoffs, hiring freeze, cost-cutting, a revenue slowdown coupled with a market sell-off. After a 13-year-long bull run, gloom seems to have set in as tech companies grapple with a floundering economic outlook.
Rising inflation, interest rate hikes, strengthening of the US dollar, Russia-Ukraine war, and foreign institutional investors taking their money out. This made sure that Indian stocks came rolling right down. Well, the Indian markets were not as badly hurt as the foreign ones, but the damage was done. And this is where the growth run stopped. New age Indian stocks saw massive dip in valuations because they were growing at all costs, right? And so they didn't have promising business fundamentals or long-term strategic decision-making capability. Case in point, Nykaa, which dropped by 62% after listing, Policybazaar by 58%, and Zomato, which went from having a market cap of 1 lakh crores in July 21 to 45,000 crores in December 22. That's more than half of its value just gone. And take Paytm stock. It actually fell more than 25% on the day of the listing itself. And when you zoom out, new age Indian startups went from having a combined market cap of almost 4 lakh crores in December 21 to only about 1.5 lakh crores in December 22. That's almost 2/3 value just gone. So all of this brings us to one central point. There's a massive difference between how startups function in private markets compared to when they go public.
Getting public becomes like a adulthood, and getting a private unicorn is like a teenage.
And that is why the Paytm story is massive news for Indian startups. Take brands like Oyo, Boat, PhonePe, Swiggy, and so many more in the lineup to go public soon. They now have a complete playbook to launch their IPO. And here are 4 massive learnings you'll see every IPO-bound company implementing soon. First, communicate their core business clearly. You see, on the day of listing, Paytm's CEO constantly complained that the public doesn't understand Paytm's complex business model.
Whenever you bring a new business model, whenever you bring something new, it takes a lot for people to understand.
But in reality, Paytm themselves were confused on the right area to focus then. They kept trying to explain the full range of their business, while missing the point of what was vital and earned them more cash. Second, promise a number and over-deliver on it. Paytm learned this from Facebook. You see, Facebook themselves had a disastrous IPO. They fell to their lowest price within 4 months of listing. Markets were upset because Facebook didn't do well on mobile revenues. But in August 2013, Facebook revealed 50% more ad revenue than was expected out of it. And since then, Facebook has continued to double on everything mobile, and they practically rule the space when it comes to mobile. Well, it's the same with Paytm. They had promised operational profitability by September of 2023, but announced it in February itself. They gave a great sign to the markets, which were happy and rewarded them with an uptick in their stock price. Third, focus on one market segment that gives you a large cash pool. Vijay Shekhar Sharma has now said, there are 2 core businesses for Paytm. Payments, which includes things like their QR code scanner, audio box, merchant services, and their technology platform, which will give them scale. Whereas credit disbursements is what will drive actual profitability. See, Paytm is bullish on making lending available to tier 2, tier 3 business owners that have not historically had credit access from banks. The problem there is that not having a bank account or a credit history made banks hurl these people away. But it's different with Paytm. With all the merchants' data available to them via QR and card machines, Paytm willingly gives them credit. These small businesses have really healthy balance sheets, but have historically stayed away from the radar of banks. So Paytm disbursed 10.5 million loans amounting to about Rs 10,000 crores in this quarter. And their total number of unique borrowers increased by 1.4 million to reach 8.1 million as of December 22. And lastly, companies will show a clear path to profitability. Markets and investors are no longer rewarding growth at all costs. They want to see if the company's business model is self-sustaining and can scale massively without burning money. Startups who are listing soon may not actually be profitable, but showcasing a clear path to profitability and the levers to get there will make all the difference. Paytm was one of the first new age Indian startups to go public, and they even might become pioneers for how future Indian startups think about taking their companies public. As is already evident with Zomato's CEO, who tweeted that they are working on profitability wholeheartedly. New age IPO bound startups will have a tried and tested model before they launch their IPO. You see, Dhanda is the name of the game now. Flashing user growth and engagement numbers won't win the market's trust anymore. But will it stop the bleeding for retail investors soon? We'll have to wait and watch. If you enjoyed that video, please do like and share it. I'll see you in the next one.